So if you know that if you get $1, you're going to get $15 back, then people are willing to give millions to anybody who can get 51% on blackjack, then we should be able to put millions of dollars into a company where you put $1 in, you get $15 back.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
We've been looking at the lean canvas. Some have been focusing on the right customer, but not really being very clear what the problems are. Some are not really thoughtful about what the customer persona is. We looked at the unit economics. So we gave a real life example of a company that has about $100,000 of lifetime value per customer they bring in. The reason why is that they charge each company about $1,000 per month. The company has about 80% profit margin because digital SaaS, and the lifetime of this company is about 10 years. And then every year they are able to raise the prices or sell more modules. So it is very different from selling. So if you sell a peanut for $1 per packet, then the margin of that is maybe closer to 20 cents because it's a consumer good. So you're only making 20 cents on that bag of peanuts. Then frequency of purchase or the loyalty of that is a one-off purchase is 20 cents, or you buy it twice more, so you buy it, make 60 cents. Then you're never going to charge more for peanuts over time. So therefore, the maximum amount of dollar you're going to get is about dollars of profit from a person who buys your peanuts. So you have to be thoughtful because that changes the dynamics for how you think about marketing as well. If you know that the end customer is only worth, at the end of the day, only $1 of total profit, then you better put your peanuts somewhere. You're not doing a lot of marketing. You don't see TV ads. You don't see Facebook ads chasing you to sell you a packet of peanuts. They're just going to put the peanuts next to the checkout counter for you to buy last minute. Whereas if we know that you are worth $100,000, then we're willing to do a lot of work to cultivate you. So Tiffany's or jewelry brands will do a lot of work because as a luxury provider, if we're able to make sure that you believe that your dream watch is a Rolex watch. And so I was at F1, and then you look at the F1, they're the Rolex. Why? They felt like it's worth it because they feel like the type of people who watch F1, they will eventually grow up to buy a Rolex. And so they're willing to spend that kind of marketing, even though there's no measurable benefit. Nobody looks at an ad in front of the F1 race and says, wow, I need to buy my F1 Rolex watch now. It makes 0 sense altogether. But Rolex is everywhere in there. So same thing for your luxury marketing, all of your brand marketing, your lifestyle ads. If you go to the airport, you see Anna de Armas. She's busy advertising multiple perfumes or jewelry brands and so forth. So be thoughtful about that because you're at the airport, you're not there to buy a bag or jewelry straight away. So again, they're willing to spend all that money because they're willing to do marketing way in advance, 1 year, 5 years, 10 years in advance of you actually making a decision to purchase it eventually. So it's marketing, the sales, the onboarding costs, and the attrition that happens. So you'll be thinking to yourself, are we looking at organic marketing? Someone's referring you? Is it something that's paid marketing? We still talk about sales. If you look at the sales reps for your Hermes or your Birkin bag or whatever it is, then you see that there's a sales process where technically that they seem like customer support, but actually they're being paid on commission. They're there to sell you on that experience they have there as well. And then we talk about onboarding, is that when you buy something that's there, you have to get onboarded. There's a customer support dynamic. There's a true cost of it. And of course, even if you do all that work, they may or may not actually follow through all the way, and they will not necessarily stay with you versus those that actually will stay with you. And so as a result, for this real life company, the pot of gold is $100,000 per customer. But what is the key is that even though there's a pot of gold, they are spending about $5,000 on marketing, and then they spend about $1,000 on sales. Then they spend about $1,000 to get that company onboarded, and then only 1% will drop out, right? So as a result, the total acquisition cost is roughly about $7,000 for this type of company. And the reason why it's important is that if you have a pot of gold that's about $100,000, but you're only spending about $7,000 to acquire that, that means that you're making about 12 to 20x. So every $7,000 I spend, I get about $100,000 back, right? And you get a payback within 12 months because your cost is about $7,000, but within the first year, you're getting about $10,000 to get paid back within 12 months. And the crux of that is that as a result, is that this company is basically putting in $1 in every dollar they put into marketing or sales gets $15 back eventually. Now, it may not come back immediately, but the $15 will show up over the next 2, 3, 4, 5, 6, 7, 8, 9, 10 years. So every dollar they put in gets $15 back. And this is actually kind of the magic of startups, is that we then realize that if your company, for every dollar that you put in gets $15 back, then we should go, right? If you go to the casino now, and if you're able to be better than everybody else for blackjack because you cheat, you just cheat, you count cards, you cheat a little bit better, you know everybody else, and if you can make 52%, you can win 52% of the stake, right? Then people will give you millions of dollars to go to the casino and keep playing over and over again, 51%, 52%, because they know that every time you play, you're going to get 1% more, and then that's what happens, right? And therefore, if you count cards, after you do too well at blackjack for a while, the casinos will kick you out because you're only supposed to win 49%, 48%, even as the best player possible. So if you know that if you get $1, you're going to get $15 back, then people are willing to give millions of dollars to anybody who can get 51% on blackjack, then we should be able to put millions of dollars into a company where you put $1 in, you get $15 back. And so blitzscaling is the phrase that we had. So Uber believed that they had that blitzscale. So they put $1 into what we saw, that Uber, for every dollar you put in, they eventually got $5 back. So they raised a certain amount of money, they got billions of dollars, and Uber is now a public company, but over the course of that fundraising history, every dollar you put in got $5 out. And when they realized they had that cash machine, then what they were able to do was there's a blitzscale. So they expanded aggressively. They wanted to copy and paste that to Southeast Asia, to China, to Russia, the Middle East. Eventually they lost because they didn't have the network effects, so they exited. Same thing for Gojek and Grab. Gojek recently exited from Vietnam, so they spent $200 million because they want to put money in, because they believe that if they put $200 million in, they'll eventually get $200 million back, or $1 billion. But because of the economics that didn't work out for them, maybe because some people argue they didn't put enough money, they should put more money in than Grab, so they should become number one, then they'll have gotten money out of the system. But some people say they were too conservative, and then other people say they were too aggressive and they should have exited earlier and not spend $200 million to get $0 out at the end of the day. So blitzscaling is a very complicated, and many in the future will eventually be debating this, because some will basically say, we make money now. We need to expand aggressively because now the opportunity to do so before our competitors wake up, and we need to do so as aggressively as possible. And then somebody in the room will be like, that's really stupid. We need to be conservative. We shouldn't put so much money. And then you're going to be like, you're such a wuss. I can't believe you don't want to double down. I'm going to fight you. I can't believe you're going to waste money. Our competitor has people like you who are stupid, and they will also blitzscale. And suddenly there'll be two Goliaths fighting each other for a not very profitable market. And then we'll say, well, the trick is if the Goliath wants to fight us, we should raise even more money so that we can out-Goliath the Goliath. And then you will say, that's the stupidest thing I've heard. And then all of you have a big fight. And then your finance team, your banker, your VC, everybody's having this argument. And I've seen this argument happen every month for the past 7 years of my startup life. Like every month I'm meeting a founder, or I'm investing in a startup, or we're debating in a team. Every month we're making a decision. Should we scale more aggressively? Is it too early? Is it premature? Do we understand the unit economics? Or what is the competitor going to do? And literally we just had this argument. This 2 days ago, the founder came up to me and said, Jeremy, we need a blitzscale because there's an opportunity because of AI wave, and our competitors are going to kill us if we don't. And then all of us sit down in the morning. He said, I'm going to do this. And he's like, I opened up the round today. I want to raise $1 million to quickly kind of scale faster before the next round, which is probably going to be a $20 million round. And so by the morning, I was like, thought about it. By afternoon, I was like, evening, I did a call to the team. I said, we got to do this investment. We told him we want to do an investment. And then he messaged back and said, sorry, the round is oversubscribed. Or everybody agreed that I should scale aggressively at the age of 21 years old for my AI startup. And so now we're busy debating, because so my lesson to me was when he was proposing to me that he wants to blitzscale, I should have been more aggressive and I should have been straight away. It's like, that's a great idea, let's do it, put my allocation in, put my money in. But turns out I'm too slow, I can't wait 8 hours to think about it and whatever it is. So because all of his other VCs basically said, I agree with you, you also need to scale faster before the competitors come in. Because he's 21 years old, he understands a certain demographic in this Gen Z dynamic. He also understands he's got a good idea, he's got the right relationships. So it'll be quite interesting to see how that happens. But there's good blitzscaling, but also we have negative versions that are blitzscaling as well. So as a result, the core thesis is that from a VC perspective, is that if the startup is able to put $1 in and eventually get $15 back, then I should put in $10 million and I should get $150 million back, right? And I think that's the crux of the VC side. And I think this is why it's so exciting, and it's why you see a lot of people who are in finance eventually drift their way into VC, because they're like, I don't care about the historicals, I care about the future. I'm here about making aggressive bets, to be a cowboy, I want to play poker, and I want to make that bet. But I think also we know that there are many companies where we put $10 million and we get $0 back. So for example, we talked about it in past, but a lot of us remember the bike sharing war. So remember all those bicycles that were piling up. So all these Chinese or VC funded, so there's VC funded startups that were putting bicycles everywhere. There were Chinese competitors that were also VC funded, expanding, because they were kind of like Uber. They were like, wait, we made the unit economics work in China for bike sharing, right? Those bicycles they have. And so all of them, all dogpiled in Singapore, said, we need to blitzscale, we need to expand to Singapore and get the market. The funny thing is that the founder, he is a Burmese Singaporean, and he graduated, he was a senior, and he graduated and he said, I'm going to launch this company. And he had no VC money because no VC believed in him that he could do it. And eventually he kept growing his small fleet and he sought the bicycles, etc. And then eventually the VC offered him some money, but the VC said some stupid stuff that he didn't agree with in the strategy. So he said no to the VC. The key thing is that this guy raised zero VC money and he beat everybody else in Singapore. So your Any Wheel, which is the green color bicycle that you see anywhere, was founded by a university senior, a fourth-year student. He said, I want to do this. And he out-executed everybody, okay? So he executed all the millions of dollars, the free bicycles, the Chinese guy, and now he's rich. He has good cars, he has a nice house. You guys saw Zenith Education. He's already built $1 million business. We saw Tay, who's also built $1 million business. There's a lot of successful university students who eventually go off to succeed and build these businesses. But I think we have to be thoughtful. But in this case, in Tay, he raised zero venture capital. His point of view was the other companies are being stupid. They have been suckered by too much money, and then we are going to operate in a more efficient way to outlast them. So lots of competition about that way.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.